I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. Welcome back to the show, Drew.
Thanks for having me on, Jim.
Drew, the rally that we've seen in equities since the Christmas lows continues. Do you think equity markets will make all-time highs soon?
Yeah, when we talk about the U.S. equity markets, they are very close. I mean, one good day's rally away from being back at the all-time highs that we saw towards the end of 2018. This market bounce, what many market participants were thinking it was going to be, was a bounce out of the Christmas lows, and then likely to see a rollover in prices that just hasn't happened. We've seen equity markets just continue to trade higher and higher. Before yesterday, the S&P was up 8 days in a row. I think Apple was up 9 days in a row. And it's confused a lot of people. I mean, we can look at the fundamental economic picture globally, and we continue to see that slow. This morning, the IMF again downgraded global GDP numbers, their forecast going forward. So the slowing global economy seems to be a bit of a known entity, and yet, equity prices continue to move back towards their recent highs and not that far away from all-time highs. So if you ask yourself what shifted, why aren't investors worried about this slowing global economic picture? I think that's because we've seen the central banks step in and say, they're now worried about the slowing economic growth globally. And because they're worried, we've got interest rates moving back lower. We've had the Fed basically come out and say they're going to stay patient, so they're not going to raise rates or not expected to raise rates as we go through this year. The ECB, the same thing. They're not going to raise rates this year like they were supposed to as we were going into the end of last year. So you've had the worry almost taken out of the investors' hands into the central bankers' hands. They've turned dovish. They're going to keep interest rates lower. They're going to be ready and or willing to take on more quantitative easing style measures. And that seems to have just given the investor the green light to say, okay, if I'm not going to be paid for holding bonds, that's the yield on treasuries or other global paper is moving lower again, then I should put my money into equities, and the central banks have my back. So it's been that sort of sentiment that has just been marching this equity market higher. Now we are getting to exhausted and overdone levels, depending on which different readings you're looking at. So this may be one of those risky periods where in the next couple of weeks we either break out to new highs and maybe there's less risk in that. But if we're right below those previous all-time highs, this could be sort of the risky week or two to be invested in case we do see some of that rollover start to come into the equity market.
Is it time for people to look at possible shelters?
Shelters in which way?
To protect yourself from a massive downturn or a downturn in the market.
Yeah, so again, I think that is a function of timing to some degree. If you've got a lump sum of capital now, is now the time to invest it all in equities? I wouldn't think so. Again, I think we're in a sort of very tricky sort of week or couple week period where we either break out and then maybe equities can run even further as they go to new all-time highs, or at this level you say, hey, can I take some defensive measures, whether that's buying put options on some of your bigger positions, having more money in bonds, maybe allocating some money to gold, keeping it out of the equity market that has had, a tremendous run through the first start of this year, and diversifying it, taking some of the risk out of that specific asset, because I do think we are, like I say, in that sort of few-week period where we could see some possible change in direction, or at least a sizable pullback.
We'll have more with Drew Zimmerman right after the break.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, we had the European Central Bank out early this morning and the Fed minutes out later in the day. Are both central banks on the same track?
Yeah, so that was sort of what I alluded to earlier with the central banks coming to the rescue of the market, saying, hey, we're going to be dovish. We're taking the worry of the slowing global growth into our own hands. So the ECB out this morning with their interest rate announcement, leaving it on hold. That was a shift earlier in the year to say, we're not going to raise rates in the summer like we thought we would originally as we're going through 2018. So they're on hold through the rest of this year. And they have already launched the new TLTROs, so they'll be going back to easier financing that's made available. So again, just a very dovish tilt. Now, the Fed earlier this year as well had taken that same dovish tilt. So this was the minutes of the last meeting that we were getting. It was expected to emphasize the fact that they were going to be patient on raising interest rates further as we go through this year. Also look at how they were going to end quantitative tightening. The fact that they're going to now reinvest the mortgage bonds that they have on their books. As those expire, they'll buy treasuries. But it was interesting at the end of the segment with the ECB, Draghi was saying, we have all these instruments and we have the full ability to use all of these instruments. So again, Draghi had a famous whatever it takes line years ago when the euro saw a big drop off. And that was sort of a reiteration of that in the market's minds, where we got to see Draghi coming out and saying, we as the ECB will do whatever it takes, whatever we can, use all of our instruments to keep the euro economy going. So while you had a very dovish tilt this morning in the Fed, in the ECB, the Fed this morning in their minutes from their last meeting was saying, we think that, yes, things are slowing globally. However, they're still fairly strong in the United States. And when the market was expecting them to talk about the possibility of cutting rates, many members there saw the possibility of them still raising rates as we go through this year. Again, they're going to be data dependent and very patient. But again, that was a little bit of a different opinion than what the market had going into the meeting. And to me, to highlight the difference between the two of them was, again, the ECB and Draghi sounding very dovish, willing to do whatever it takes, and the Fed saying, hey, things are looking okay in the U.S. Maybe we're going to be raising rates again later this year, even though that's not what we expect, it's still possible. So to me, that's a divergence. When you see that divergence in central bank policy, we usually see shifts in currency, first and foremost. So the bond market reacted to that. We see bonds, they got sold off on the announcement. They've since come back again a little bit. So rates still are going lower. So maybe the bond market didn't fully believe the Fed was going to be raising rates this year. And again, in the currency space, we didn't really see any big moves immediately in the currency space either. But again, if I take a step back and look over time, in a week from now, will we be able to look back at this divergence and say, that's why we're seeing the U.S. dollar get stronger? So that's what I'm looking for. I think the Fed is, again, everybody uses this phrase, but the cleanest dirty shirt in the pile. The economy globally has some issues, but is the U.S. sort of a bright spot? Yes, I still think it is. It's not maybe as bright as it had been 6 months ago, but it's still looking relatively robust compared to other economies in the world.
What does this diverging central bank policy mean for investors?
That's a very good question. In the equity markets, I think if the Fed was seen to be coming back to being more hawkish and possibly raising rates later this year, then I think there's some need to be cautious with equity markets. Again, I think it's been the big pivot that we saw at the beginning of this year and how easy the Fed was going to be that really saw the equity market rally like it has. And if they're going to take that rally, take the easier financial conditions, the fact that rates are lower, to raise rates again and or be more hawkish with policy in general, then, that should give equity investors some pause. And at the same time, if you've got the ECB being easier, continuing to be easier going forward, maybe we see equity markets outside of the U.S. start to perform relatively well. Again, if you've got assets being pumped up from those central banks, there will be some flow that happens globally. But again, you might see outperformance as there's, easier liquidity pumped into those markets, and that easy liquidity is what usually gives rise to asset prices. And the near term there will be asset prices that are in that direct market. So again, seeing maybe European equities start to perform better relative to U.S. equities, because in the past we've seen U.S. equities do so much better. But I don't know that's a clear, one-to-one correlation, but possible with easier money policy outside of the United States.
Now, some people have said this time it's different, and we all laugh because so often this time is not different. But is it different this time? The central banks seem to be a whole lot more sensitive to what the economy might do, and that they might be able to take measures to prevent a massive collapse. Is this time different?
I think they maybe sense that it could be different this time, and maybe why they're trying to get ahead of it more and quickly this time. So I don't believe this time is different. I think we're in the midst of a lot of confusion in an experiment that we've never seen before. Nobody really knows what to do or what happens next, and I think they're just trying to do their best. And again, with volatility being as low as it is, they want to keep volatility low because that sort of keeps things rolling. So again, I think they're trying to sort of keep the tires inflated, so that this show kind of keeps rolling on, to put it very simply, I guess.
Why do you think the pound and the euro haven't fallen more with all this confusion over Brexit?
Yeah, there is a lot of confusion on Brexit. It's been just dragging on, and as we run into one deadline, it moves into another deadline, and so on and so forth. But at the same time, as each deadline comes and goes, we sort of get a little reprieve. And I think there's maybe some aspect of investors that are, wondering where this goes, how long it goes for. Some of the economic data through Britain has actually been better. Some of that's being attributed to the fact that they're sort of front-running the possibility of a hard Brexit. So, they're stockpiling goods, they're building more goods, and that's, pumping up the economic numbers a little bit falsely. However, on the currency front, it's again tough to say. I mean, the currency market will try and suss out which direction it goes, but again, it seems to be a toss-up of one deadline to the next, and what used to be a hard deadline isn't a hard deadline anymore. So, if there isn't any immediate hard consequence, then maybe the currency reaction doesn't need to be as severe as it would be otherwise. If there was, if the original deadline was a hard Brexit deadline, and that came and went, then I think you would obviously see a very severe currency move. But given all these deadlines going forward continue to just be kind of wishy-washy and not mean a lot, then there's no immediate need to see, a big fluctuation in the currency or a big repricing in the currency.
We'll have more with Drew Zimmerman right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, oil prices have rallied since Christmas. Do oil prices keep going higher as we go into so-called driving season?
Yeah, so the oil price and the equity market have been very similar charts. I mean, they both topped out October 3rd at the end of last year. Both went down into the Christmas lows and have both rallied significantly. I mean, crude market from those Christmas time lows is up over 50%, up over 40% on the year-to-date numbers so far. So I think it's part of the, again, resurgence of equity, of risk-taking, of investor psychology, also that the central banks will stimulate and global growth and demand for crude products will continue to rise. At the same time, there's been other measures taken by OPEC and friends, so OPEC and Russia, or, more importantly, Saudi, cutting a huge amount of oil production to try and balance the supply-demand picture to see higher prices. And we've also had Russia agree to that. Well, they haven't, fully agreed to their production target levels. That's also helped the supply-demand picture. And then the other aspect that's always important in oil is sort of the geopolitical side of it. So we've had a geopolitical side that's really affected supply-demand as well, and that's namely out of Iran and Venezuela. Venezuela production is just grinding to a halt almost as that country really runs into a whole magnitude of problems. Iran is facing sanctions from the U.S. So previously, there have been several countries that were granted waivers from the Iranian oil sanctions to be able to trade oil with Iran. I think we'll find out in the next couple of weeks if those waivers will be extended or granted in some way, shape, or form, which could, again, bring a little supply back to the global market that right now it's got to be pricing out. And then just recently, we've also had more geopolitical unrest in Libya that's taken a little bit more off the supply side of the global supply picture as well. So it's been sort of a multifaceted rally. I think we are getting near this 64, 65 level is sort of a near-term price target that I had just as far as resistance levels on price. We also have, Brent prices over $70 a barrel. WTI prices, like I say, close to 64, 65. So you've got Trump then coming out saying, we're going into driving season. I don't want gas prices going up as much as they are. He sees that as a tax on the American people, and he can, sort of push his influence onto Saudi especially, but the OPEC members on Russia, and say, we need to be producing more oil or allowing more oil onto the global supply market to keep prices lower, because I don't want oil prices going higher. That's a tax on the American people at a time when they really don't need it because they're struggling with other economic events. So I think, again, like the equity market, we're nearing a point of resistance, of exhaustion. And to me, if I had to guess where the next $5 or $6 would be, I think it would be in a pullback rather than getting WTI above $70. Again, there's always geopolitical shocks that can happen that can change that very quickly. But as we've seen, not only the front month price that everybody talks about, but the structure of crude oil, that's the month-to-month crude structure, go from contango, that's where the front month prices are cheaper than back month, to now having the front month prices be the most highly valued. That's backwardation. It incentivizes U.S. shale producers to produce all the oil that they can now, because now is when the oil is worth the most. It's not worth more in 3 months, 6 months, or a year. So I think you'll see that U.S. shale production machine really, step up even more than they have in the past. And that's sort of the near-term cap effect of more production coming online from the U.S. that should keep prices, I think, running into resistance around this level. So that's my view is like equities. I think we're at, a rather tricky point. It's been a very strong run in the last 3 to 4 months, to get us to this level. And, any sort of a pullback would be warranted.
Drew, thank you so much for chatting with us.
Thanks for taking the time, Jim. Appreciate it.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. You're listening to HoweStreet.com radio. Find us on Twitter at HoweStreet. If you have any questions for Drew or any of our other guests, you can send them to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.